everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. So I got a picture here of Punxsutawney Phil wearing a top hat, just to make it a little funny. But anyways, we just saw Punxsutawney Phil come out early February here, which was about a week ago. And the big question is, does he see his shadow or not? So if he sees his shadow, that means that spring is coming. So we want him to see his shadow. At least everybody up north does. Here it doesn't matter too much in Florida. But anyway, he did see his shadow. So that means spring is coming. We are not going to have 6 more weeks of winter. And so what's the tie-in here with the market? So I want to talk about today is, what is the market anticipating? Are we expecting to see more winter, or are we expecting to see a recovery or spring? And I'm going to talk about some of the reasons why we think that maybe spring is coming, and the market is kind of pricing in spring. But I also want to talk about some of the things that might keep spring from coming. Maybe it's going to be more of a winter season, and what we're doing with the portfolios to take advantage of that. I hope you enjoy. Alright, so before we get into winter or spring, let's go over real quick the asset class returns for January, which is in the blue bars here. And the green shows the last 12 months, which still shows some pretty solid numbers across the board. You can see large cap stocks were still up in January, even though we had that huge fast and furious run up at the end of the year. And so about 1.68 for large cap. Small cap and real estate were actually down pretty good. We actually saw interest rates creep up a little bit. We got a lot of good economic figures showing that the economy is pretty strong. And so you might be like, well, why is that making small caps and real estate go down? It's because interest rates went up, and they're very cyclical or very interest rate sensitive. So they kind of took a little bit of a backseat to large cap in January. We also saw the same thing in international, especially emerging markets. We're seeing China really slow down. I mean, they're actually seeing deflation over there, and their economy seems to be pretty stagnant. And so, of course, fixed income was down again. We had rates go up a little bit. High yield was pretty flat. Commodities was up because anytime the economy starts to look a little bit better and that raises potential inflation a little bit, you get commodities to go up as well. So already for February, since we're pretty much middle of February already, we have seen the market continue to be pretty strong, and we're actually seeing record highs now for the S&P 500, and a lot of it is because the economy has been really resilient and continuing to be pretty strong. Alright, so I'm going to show you a couple quick charts that show that spring is coming and the stock market is anticipating this to continue. So we'll have to see. But the first one here is the initial jobless claims. This is the people that are just signing up to go for unemployment insurance. So that means they maybe just lost their job. And so here you can see there was a huge spike after COVID, but it's been coming down steadily, and you can see it is super low right now, and it is not ticking up. And so that's a really strong sign of a strong labor market and strong economy. And when people are working, frankly, they're still out there and out there spending. So that's a good sign to come for the economy. All right, number 2, we still have a lot of excess savings. And so I was one that thought that this excess savings would have been going down faster than it was, especially based on this slope here. But it does appear that there's still a pretty good amount of excess savings in people's checking accounts and money market accounts, savings accounts. And so we're looking at still close to $1 trillion, which is quite a bit higher than if you look at the pre-COVID trend, which would have been pretty much a zero. And so there's still a lot of money on the sidelines and money in people's bank accounts that could be used for future spending. And of course, probably the biggest reason the stock market is anticipating spring is that we continue to see inflation go down. Again, that helps consumers. That helps them stretch their dollar a little longer, with those savings. It also helps companies continue to be profitable even when wages have been going up, which was one of the concerns, is that would keep inflation going or it would squeeze profits from companies. But when inflation is coming down, those raw materials prices are going down. That allows them to still continue to make decent earnings. And so right now you can see CPI headline is 3.3 and the core is 3.9. And that's actually still a little high, but it's getting pretty darn close to the 2% that the Fed is shooting for. All right, so what's the flip side? So I'm going to show you 3 quick slides here that show that maybe there are some really cold snow chances coming our way and winter isn't quite over yet. In fact, what we're starting to see here, as you can see on this chart, is the delinquency rates on credit cards and auto are really starting to go up. In other words, that maybe there's still a lot of cash on the sidelines, but that's not the average person, and we're starting to see more of your lower income people start to really rack up credit card and auto debt. And that's not a good sign for the economy. And of course, we also have interest rates that have gone a lot higher as the Fed's been raising interest rates for the last year and a half. And here we have the mortgage rates, which is influencing, of course, people buying homes, home builders, construction, and a lot of different kinds of jobs in the economy. Right now we're at about 6.6% on a 30-year mortgage. So it has come down a little bit, but it's still pretty darn high. I mean, we were in the 3s and 4s here not that long ago. And prices of homes have pretty much stayed about the same. So that just makes it really, really hard for your average Joe to buy a home or to afford the mortgage payments on them, which squeezes all the other things that they're going to spend their money on potentially. So that is not a good sign also for the economy. And my last slide with the storm clouds is we have the debt of the U.S. government. And it's been continuing to go down. In fact, since COVID, our debt has gone up pretty dramatically. So you can see how it's gone up really quickly here, 2020, 2021, 2022, 2023. And the projection is for it to continue to go up at a almost unsustainable pace. Right now we're at about 100%. Debt to GDP ratio, and it's looking to go up by 21% or more actually over the next 10 years. And the reason this is a big deal is because it squeezes out all the other spending that the government can do. It makes it harder for them to do fiscal stimulus. It makes it harder to provide health care. It makes it harder to grant government contracts for defense spending and all these other initiatives that they might have. So it is going to have a negative effect on the economy as well. All right, so as you guys can see, it is not as simple as it looks. We're seeing the stock market go up. It's anticipating spring. Punxsutawney Phil is seeing a shadow. But, Punxsutawney Phil does not have the greatest track record. You do realize he gets it wrong a lot more than he gets it right. And oftentimes the stock market gets it wrong too. Now, I don't know for sure. I do see that there's still a lot of storm clouds out there that could bring some winter storms. So I'm not completely convinced yet, as you can see by the data. But I am becoming a little bit more optimistic. Okay, so I do have my finger on the trigger to add a little bit more risk as those inflation numbers continue to hold up and maybe continue to go down, as the economy hangs in there, as the Fed maybe starts to lower the Fed rates and lower interest rates overall. So we're definitely anticipating that and hope for that. But in the meantime, we're staying neutral until we see a little bit more evidence of this. We're continuing to add to real estate, adding to higher income equities to add a little bit more income coming in for a little bit more security, moving that, trimming a little bit of that from large cap tech that has run up a lot, reducing cash, adding to higher quality bonds and a little bit more duration to lock in those yields through our rebalancing process. All right. So if you guys have any questions, feel free to reach out. Hope you enjoyed the video, and God bless.